Welcome to the deep dive. This morning, we're looking at a retail story that is just, it's the perfect market paradox right now. We're talking about Land's End, ticker LE, and their Q3 results that dropped before the bell on December 9th. And our mission today is pretty straightforward. We need to figure out how management's story of strong profits and margin control could be so at odds with what the market did. Because the market delivered this immediate and pretty punitive judgment. The stock just cratered.
It really did. And that tension is the whole story here. Land's End delivered, a classic mixed bag, but the market only cared about one half of it. Look at the profit side. Adjusted EPS came in at 21 cents. That blew past the 17-cent consensus, a 24% beat. That's a clear operational win. But, and this is the big, but revenue was $317.5 million. The street was looking for something like $331, $334 million. So that 4 to 5% miss is all anyone heard. The stock dropped, 18, almost 19% in pre-market, and it closed down nearly 9%. It just shows that right now, top-line stagnation trumps everything else, plain and simple.
Okay, let's unpack that, because the bottom line numbers were legitimately transformative.
Yep.
It wasn't just a beat. That 21 cents is a 250% jump year over year. They swung back into the black. Net income was $5.2 million, which is a $5.8 million improvement from the loss last year. That suggests a real turnaround is happening.
It does, and that's what management is hanging their hat on. But, retail stocks, especially turnaround stories, they get judged so mercilessly on growth. And their revenue was basically flat year over year, down 0.3%. So it's immediately obvious the entire profit beat came from margins. It proves their strategy of cutting costs and, being smarter about promotions is working. It's just not translating to more sales volume yet.
And volume is what gets investors excited.
Exactly. When a stock's already had a good run and LE was up 21% for the year coming into this, you need proof of growth. Missing on revenue just signals that the turnaround is still struggling to really grab hold with consumers. And the trading volume, almost 3 times the average, tells you that a lot of people just decided to cash in their chips.
Which forces us to really focus on management's argument, this idea of profitable growth over just chasing volume. This is the whole quality of earnings story. So let's talk margins. Gross margin expanded 120 basis points. That's 1.2 percentage points for our listeners. It hit 51.8%. That's a record for them since the spinoff. What exactly drove that incredible gain?
It was pure discipline.
Yeah.
Management focused on higher average unit retails, AURs, so they sold fewer items at those deep discounts. It's all about promotional productivity, inventory efficiency. You combine that with more full price selling and a really favorable mix from their high margin licensing business, and that's how you get that lift.
Okay, wait, I have to challenge that a bit. Management said their core U.S. e-commerce revenue was down 3.4%. They framed it as, an intentional result of this new discipline. But doesn't the market just look at that and see people leaving the brand? Is this a real strategic shift or just clever cost cutting that you can't repeat if demand keeps falling?
That is the multi-billion-dollar question, isn't it? Management is insisting this is a necessary sacrifice. They're shedding low-quality, heavily discounted sales to strengthen the brand. And the proof is in the adjusted EBITDA. It jumped 28%, almost $26 million. That cash engine is getting stronger. But you're absolutely right. The market is skeptical. They want proof that this efficiency can turn into actual growth.
So if they're deliberately slowing down U.S. e-commerce to clean things up, where is the real growth coming from?
It's coming from the B2B side and these asset-light channels, which are naturally high margin. First, Outfitters. Their uniform business was up 7.4%. Part of that was a strong back-to-school season and picking up market share after a competitor left the space.
But the Delta Airlines contract has to be the real headline there.
Oh, absolutely. Securing that long-term deal with Delta to make uniforms for over 60,000 employees, that's huge. It gives them massive revenue stability that isn't tied to consumer spending whims. It's a multi-year predictable stream of income. Not many struggling retailers have something like that.
And beyond uniforms, what about their digital distribution? Licensing revenue up over 30%. That's pure gold. And the third-party marketplace business.
Yeah, the marketplace business. So Amazon, Macy's, online, that was a standout. It jumped 34% year over year. Management calls it their marketplace flywheel. And it's a key concept. These channels are efficient, they use a single pool of inventory, and crucially, they bring in new or long-lapsed customers who probably wouldn't go to the Land's End website directly.
And the product is clearly resonating there.
It is. I mean, we got that great little detail about the men's Bedford quarter zip. It didn't just sell well for them. It was the #1 bestseller in its category on Amazon during Black Friday and Cyber Monday. That proves the brand still has pull when it gets in front of the right digital audience.
Okay, so we've got the wins in B2B and marketplaces, but every turnaround has its weak spot. Let's talk about the part of the report they seemed to rush past a little, the big drag on revenue. I'm talking about Europe. European e-commerce revenue fell a staggering 20.8%. How did they explain that collapse?
The explanation was a mix of things. They pointed to more promotions in the region, so margin pressure, and just the ongoing macro issues hitting European consumers harder. And you've also got to factor in currency headwinds. When you translate euros back to dollars, the numbers shrink.
Is this just a systemic issue, or is Land's End losing ground in Europe? I mean, 20% is a lot more than just soft macro.
It suggests there are some operational challenges on top of the weak economy. They're trying to apply the U.S. marketplace strategy over there, expanding on Amazon and Debenhams. But the question is, can brand building really overcome a 20% deficit when people are just fundamentally not spending? This is their biggest near-term risk.
Let's talk inventory. It's always a red flag for investors. Inventory's up 3% year over year. In this environment, how do they justify any increase?
They framed it as strategic. They were actually happy it was only up 3%, given they had to pre-buy some merchandise to navigate tariffs and supply issues. I mean, you have to remember, just a year or two ago, retailers were dealing with like 20 or 30% inventory bloat. So for Land's End to keep it this tight, that's actually a really good sign of operational control.
So we have a company focused on margins, getting B2B stability, managing inventory. But is the brand still relevant? What do we know about their customers?
The numbers are actually pretty good. Q3 had the biggest increase in new customers since the peak of COVID in 2020. Traffic was up 25% in their U.S. digital channels. And what's really key for the long term is the demographic shift. New customers are skewing younger. They're seeing real growth with millennials and even Gen Z.
Which is a must for any legacy brand. How are they doing that?
They're going where those customers are. Their Instagram is nearing 500,000 followers. They launched a TikTok shop. They had a pop-up in New York City that got like 5 million social media impressions in just a few days. That's the kind of buzz you can't just buy.
And product customization is clearly a big part of that connection.
Absolutely. The canvas tote sales were up triple digits, all driven by new customization. And the detail I loved was the personalized embroidery. The Dachshund icon was the #1 choice for the season. It sounds small, but it tells you they're tapping into that emotional, personalized part of the brand that really resonates with a younger consumer.
Okay, finally, let's hit the guidance. What does it set them up for in Q4?
The full-year guidance is key. They're projecting revenue of $1.33 to $1.36 billion and adjusted EPS between 68 and 81 cents. To hit the high end of that range, they need a really clean holiday quarter. They have to maintain that margin discipline we saw in Q3.
Okay, let's step back now. Operationally, they seem to be executing. But strategically, there is this huge non-operational catalyst just hanging over the stock.
The elephant in the room, the board's strategic alternatives process. They started exploring a potential sale or merger back in March, and it's still ongoing. Management was completely silent on the call, but everyone knows that's the real endgame here. It's not just about one quarter's revenue.
And the stock is still lagging the market. It's basically flat over the last year, while the S&P is up, 13-14%? It's trading like a beaten-down retail ETF.
Exactly. And it highlights the two conflicting views. You've got management focused on this multi-year transformation into a higher margin brand. And then you have the market focused on the execution risk, the weakness in Europe, and the debt on the balance sheet. The market wants proof. Either the growth is coming back or that the board can deliver a sale at a nice premium.
All right, it's time for the segment we call This Is Not Financial Advice. So if management is right about the margins, but the market is right about the flat growth, how do you trade that paradox?
You're pitching this to a skeptical investment committee. What's the outrageous but plausible trade?
Okay, the thesis is this. The market just punished this company as if it's a perpetually flat growth retailer forever. And in doing so, it's completely ignoring the value from the strategic review and the growth in these high-margin channels.
So lay out the trade for me.
The trade is simple. You go long LE. The current price, down in the mid-14s after this report, that acts as a practical floor. That floor is supported by improving EBITDA and proven margin stability. They've shown they can make money even with flat sales. They've secured the base.
So downside is limited by operations, but what's the catalyst for the upside?
The catalyst is purely the outcome of that strategic review. Analyst targets are hovering around $20, which implies, 30% or more upside? We are betting on a corporate action to re-rate the stock, not on them having a perfect Christmas season. And what's the edge? Why would a buyer step in now, right after this revenue miss?
The edge is that the company just gave them clear quantitative proof that the brand's core value is rising. The long-term stability of the Delta contract. You have 34% growth in asset-light marketplaces. This proves the brand is digitally relevant and can attract a younger customer. And the outrageous part, we're betting the board announces a sale before the Q4 results could potentially disappoint on the top line again.
Yeah.
It's a race between corporate action and consumer spending.
That was definitely a high-stakes call to analyze. Land's End delivered a huge EPS beat, driven by some really surgical margin discipline. But the flat revenue and that big weakness in Europe, it triggered a swift negative reaction from the market. It just proves that in retail, the fear of stagnation often trumps the quality of your earnings.
And that is the provocative thought we should leave you with. Management is successfully pivoting this company. They're getting younger customers. They're securing structurally higher margins. With that profit engine strengthening and a strategic review underway, how much longer can the market really afford to ignore the rising quality of these earnings just because of volume? The long-term value story is getting stronger, even if the short term is punishing the stock.
Something critical to consider. Thank you for joining us for this deep dive into Land's End, and we hope you think about the implications of margin expansion in this tough retail world. We'll see you next time.